Hey guys, Donnie here. So you clicked on this video, that means you're interested in the stock market and investing, but for whatever reason you haven't started yet. Maybe you're scared of doing it, maybe you don't really know what the stock market is, but you know that you should be investing. So hopefully in this video we'll get down to the problem and get you started today. Now in this video I'm going to talk about why you should start investing in the stock market now and what that might mean or what that might look like depending on the stage of life you're in. Whether you just entered the job market, whether you're still growing your net worth, or whether you're about to enter retirement. Now, quick reminder, I am not a financial advisor. I am just a guy on YouTube expressing my opinion and views. Please do your own research before you do any financial moves. Now, with that out of the way, let's get started. Now, if you have yet to invest in the stock market because you don't know what it really is or how it works, I highly suggest watching my crash course on the stock market. You can click on it up here if you're watching on YouTube. If you're kind of scared about losing your money, your hard-earned saved money, because you've heard of horror stories in the stock market of people losing all of their money, that's usually because of panic selling, like during a crash, market crash or a market correction. You can also learn about that here in my First Time Investors movie about what not to do and what to do in the market when you first enter it. So if you still don't know why you haven't entered the stock market yet, chances are it's because you're human. Just like everyone else watching this video, the stock market is not taught in schools. No one's ever told you that you had to do it after you graduated high school. Every time they show it in movies, it's just a whole bunch of people on the stock market floor selling, buy, sell, sell. Oh my God, I lost all my money. It's all confusing and it's all very complicated, right? The thing is, the stock market is not scary. The videos I referenced earlier will help ease you into it. The stock market is a tool to help you get ahead financially, and not using that tool, the opportunity cost is just so high. Opportunity cost is what you lose by doing something else instead of another alternative. In this case, you lose having your money appreciate over time if you just let it sit in your bank account. Now, chances are, wherever you are in life, you have some money sitting around the bank account, whether it's just emergency funds or if it's for your retirement later on in life. And leaving that money in your checking or savings account is just such a wasted opportunity. Instead of having your money in the stock market grow exponentially over time, you end up with the same amount of money that you just put into your savings account, maybe with a 0.03% interest up. So maybe you gained $1 over 10, 20 years, right? But again, it goes down because of inflation. It's such a wasted opportunity that you could have so much more money at the later stages of your life instead of just having your money depreciate over time. Now, I want you to start now, because if you don't start, you're going to find a reason to not start later. You're going to lose your interest in the stock market, and it's going to be easy to forget about the stock market, and you waste all of that money, all of that free money that you should have because your money is not in the stock market. So you might argue that we're in a pandemic and there's a lot of fear around, and the stock market is probably going to crash because of all the evictions that may happen in the future or something like that, right? The problem is you're trying to time the market. And the more you do that, the more likely you are to keep putting it off because you're so scared of putting your money in just the first time that you never get started. That's the problem. People never get started because they're scared. And that's just something you have to just push through. You need to just get your feet wet. You can't just jump in the pool, or at the very least put your toe in there, because once you get started and you see that your money is actually appreciating, it's such a boost to your morale that you'll actually want to start investing more. So like I said, start now while you still have interest and while you're still here listening to me telling you to start it, because no one else is going to tell you. If you're not looking for these videos, if you don't have a friend in the stock market or a family member in the stock market that's telling you to start investing in it, you're never going to start. So start now. Now, I'm going to talk about how that may look like depending on your age or where you're at in life. So we'll go by age groups. If you want to skip ahead, if you're go ahead and look down on the links below, or maybe I'll put it up here for reference so you can just skip to that time, or go down to the links below and you can click on that time depending on your age. Now we'll start with young people, maybe let's say age 18 to 25 or something. Now is literally the best time to start because you have low overhead. You will have the largest return later in life because your time in the market is going to be so long. If you're investing in the long term, if you're not doing short-term trades, or you're not day trading or something stupid like that, right? And by low overhead, I mean you probably still live with your parents, which is a good thing. You don't have to pay for rent. You don't have to pay for food. I wish I could say the same thing. I love going to my mom's because I get free food. Love you, Mom. You develop good habits in investing. Make it your priority to put a big chunk of your paycheck into investing. Instead of your savings. Maybe put a little bit for emergencies, but the rest of it should all go in investing instead of putting it into games or things that you'll end up not doing or using in the next 5-10 years because it's just a fad, it's just a game, right? You also have the benefit of time. You have a lot of time to learn about the stock market, to learn about specific stocks that you want to invest in, the specific stocks that will rise really high. And depending on how hard you go into the stock market, you can retire super early, as early as your 30s, sometimes in your 20s, because you put so much money into the stock market early. And going back to developing good habits, it's not just investing habits that you develop. Chances are you're going to develop other habits regarding your finances. You're going to have more respect for your money because you know how much it takes to grow that money. You're not going to waste your hard-earned money on things that you're not going to care about, a day from now or several years from now. It's just a game, or it's just a pair of shoes. You don't really need that, right? All you're doing is delaying your future plans by buying things right now that will only give you a little bit of happiness right now. So you're delaying your happiness. You are borrowing future happiness for today's happiness. So start now while you have low overhead, while you have little debt, while you're still living with your parents, getting free food. Start now so you can retire early, right? And start developing those good habits. Now I'm going to move on to middle age phase, growing your wealth phase, say age 26 to 55 or something, because even if you're in your 50s, you're still growing your wealth. So your strategy is generally the same as if you were 18 to 25. The only difference is you have more obligations. You have your mortgage, maybe your student loans still. You have your car payments. You have to feed your family if you have a family. You also have less time because you're working. In this case, you probably also have larger savings account for your retirement. If you don't, you might want to get that started, and the best place to start is stocks. If you do have a large savings account, I would say not to put all of it right away in the stock market. You want to trickle in over several months, that whole amount, because if you do it all at once, you risk the possibility of a steep correction or something immediately, or just a little bit afterwards, and the value of your stock will plummet if you did it all at once. That's just a risk. You could also have the opposite happen, where you put it all at once and it happens to be at the bottom and then it skyrockets really quickly. But dollar averaging it which is what you're doing by putting it sequentially over a certain amount of time, is you're also mitigating your risk of that drop. It's a much safer tactic, especially since we're just starting investing. Now, while your returns in the stock market are not going to be as high as if you started when you were 18 or 25, because of the lifetime in the stock market is not as long, it's still going to be significantly more than if you just kept it into your savings account, because it is an exponential curve. The more money you put into it, the faster it's going to grow, and because it's growing by itself, it'll still grow much faster than if you were to keep it into your savings account. Now, if you kept it at your savings account and you just added money, it would grow linearly, right? This is your bank. If you were to put it in the stock market, it would grow exponentially. In this case, dang it. In this case, it would grow at a curve like this. So this is the stock market, right? Now, while if you were to start at 18 and retire at 50, you would be up here, and up here or down here if you started at 18. But if you start at, let's say, 30 or even 40, you might be over here by the time you're 50, right? But still, this is a significant amount. Even though you could be up here if you started when you were 18, you have way more than you did if you were to just keep adding it to your savings account. Now, the strategy changes a little bit in advanced age after 55. When you're nearing retirement and you're already starting to maybe use your savings, or you're just trying to preserve it as much as you can, putting it into growth stocks it might not be the best idea because they do fluctuate. And if you want to take a cruise somewhere but your stock has gone down yesterday, that wouldn't be the best use of your money. Instead of investing in growth stocks, you would be investing in dividend stocks, which are much more, much less risky. They are not as volatile because they're usually companies that are timeless. I don't want to say timeless, but they are stable, like a Coca-Cola or AT&T or something like that. Coca-Cola, no one's gonna stop drinking that. Chances are no one's going to stop drinking that. Even the Soda Stream didn't really get that away. But anyway, dividend stocks, what they do is they instead of their growth, they pay their profits to their stockholders. So if you have a lot of stock in Coca-Cola, they will pay you a small amount per stock. And while this is taxed as if it was your income, it's still extra money that you would be getting that you normally wouldn't be if it was just sitting in your bank account, right? So it's a big supplement. And remember that you don't get taxed from selling stock if you sell it at a loss, or if it stays stagnant. So if it doesn't grow, you're really just parking your money in the stock market and you're just collecting the dividends, which is nice for retirement. There are a lot of calculators out there that let you calculate how much money you need to put into dividend stocks and then live off of the dividends only. So say, I think AT&T, you put $7 million in there, or $5 million into AT&T, and then you can collect $7,000 in dividend stocks every month. Just live off that. Now, while we're probably not going to get to that amount, keeping your savings in dividend stocks is going to supplement your Social Security or something a lot, and that'll really help. Now, something a lot of people don't talk about is the inheritance of stocks. When a stockholder passes away and the stock is transferred to their dependent or their inheritor, the amount of gains for that stock is not taxed. So it's essentially a tax-free way of giving your money to your children. And of course, that whole time you were holding it, it was appreciating, right? So that's another reason you may want to go for growth stocks instead. If you're not going to use it for yourself, invest in the stock for your children, let them inherit that stock, and they'll be all the better for it. Okay, so we've talked about stocks and what you could possibly do at your stage of life. Now, if you're still not really sure you want to get into stocks, here's what I want you to do. I want you to download Robinhood, because it's just the fastest, easiest way, okay? Download Robinhood. If you have a friend that has a Robinhood account, or a relative or something, ask them for a referral code. Don't use mine. Use someone you know. If you can't find someone, go on Facebook, make a post, ask if anyone has a Robinhood referral code. Chances are someone will, and you're going to get a lot of links. Just click on one. get your account set up, and just put in $10, just $10, okay? And then invest it into an ETF. Let's say I like VOOG because it's a growth stock. I always talk about that for ETF. That's an S&P 500 growth ETF that prefers growth stocks over dividend stocks, okay? Just put $10 in there, invest it into VOOG or something similar, and let it sit in that account for a month or two. Don't even look at your Robinhood. It's only $10. Of course, get your free stock, right? Because of the referral. So go back in there and look at that stock in 1 or 2 months and see where it's at. Did it go down? Because chances are if it did, it probably didn't go down a lot. And it's only $10, right? Leave it in there again if it went down. Leave it in there for another 2 or 3 months. Then come back and check it out. Chances are it will have gone up significantly. Even after the first month, it'll probably have gone up a lot. And when you look at that, you might think, wow, maybe I should have put 100, maybe I should have put 1,000, maybe I should have put 10,000, because you will see the difference from $10 to what it actually is. And maybe that'll make you a believer in stocks. Remember, it's just $10. That's 2 or 3 Starbucks. That's 2 or 3 boba drinks. Just go and start it. Now, if you don't have anyone, literally no one that has Robinhood for whatever reason, I'm sure someone does. You can always use my link down in the description below. So that's it, guys. I really hope that you start doing stocks today, because there's so much to lose if you don't. If you found this helpful, entertaining or helpful, please share it with someone who you think will find it helpful as well, someone who you think should get into stocks as well. It'll help out the channel and it'll help out you guys the most. Also, like and subscribe. That'll also help me out as my channel. Don't forget to check out the links below. Again, I said Robinhood, get 1 free stock when you register. Webull will give you 4 free stocks worth up to $1,600 each when you deposit $100 into the account. And M1 Finance will give you $10 credit when you deposit $100 into the account. Thank you so much, and we will see you at the next video. Bye-bye.